This is such a Brad Human of Cirrus Research. The latest issue of the Signals Report is just out. The Signals Report is our asset allocation work, looking at stocks versus bonds, large caps versus small, growth versus value, etc. The title, Mission Creep places risk assets in limbo, high yield to widen further. The first chart here relates the sort of break in leadership we've seen in just a few short months. To the left panel, the blue bars represent the longer term trending exposures. So in that world, up until just a few months ago, the technology sectors, the financial sectors, industrials, they were leading the charge in terms of the kind of leadership stocks as we refer to them. To the right panel, though, are the spreads in terms of how those sector exposures have been cut when we look at a shorter term definition of leadership, such as the last 3 months. Some of the significant pullbacks we've seen in exposures, and to no surprise, technology, financials, industrial. On the other end, we've got fairly an eclectic mix, to some degree, telecom being defensive, but at the same time, energy. So some of these exposures have really been jumbled. To some degree, this mission creep moment is really, it explains a little bit of why the market leadership is likely to remain really in a mixed fashion. Importantly, our crowding model that flashed right at the end of January basically called for a break in leadership, price momentum strategies to weaken, valuations to work. Pretty much it played out in textbooks fashion. Real world events have also come into play here. And as a result, the weakness has been potentially even more sharp than we could imagine, given the sort of standoff that we're looking at. The bottom line, though, in terms of US market crowding, it's much more benign. The reading has come back into a neutral zone. So to some degree, we are in a bit more of a wait and watch situation than we were just 2-3 months ago. Importantly, though, this is going to be the critical driver of risk asset returns, which is the credit markets. And up until 2 months ago, we were looking at credit spreads really remaining in that 300 basis point over 10-year treasury level. Those levels are roughly 30-year lows. What we've seen in a short few weeks, though, is that this reading has moved from this 300 basis level up to about 400 basis points. So very quickly, it has escalated. Some of it is reacting to all the uncertainty. One proxy for this is the policy uncertainty index. That's the purple line. What you'll notice is it has been climbing up until a few weeks ago. But since then, this has also escalated sharply. So our belief is that it's unlikely to see the credit market remain benign when policy uncertainty is climbing and companies are really rethinking or wondering whether or not they should be signing deals. So I think this is a moment that will continue to press equity multiples and also force earnings estimates cuts as we go into this reporting season. So this is a much more defensive posture we're going to be in until we get some clarity. And then finally, the asset allocation model has remained in the overweight posture. We think that's going to continue to tumble here as we see the credit markets really tightened, and also if we see estimates start to getting pared back. Please do reach out to us with any questions, and as always, thank you very much.